Hey, good morning, options traders, and welcome back, everyone, and happy Friday. And I received an email from one of our traders asking a really good question, and he was looking at S&P 500 quotes, and he said, I was trying to get a 15 delta call and put, but I noticed that I had to go, let's say, for example, 10 strikes out of the money to get a 15 delta call, but to get that same delta, or at least negative 15, I might have to go out 20 strikes out of the money. So theoretically, they should be the same. So why do I have to go so much further out of the money to get the same delta for the puts? Well, it's a really good question, and it comes up a lot. There's a fairly simple answer. It's quite technical, but it's fairly easy. This is the volatility smile, or in this case, what he's talking about is the volatility smirk. So what is a volatility smirk, and where does it come from? Well, to answer that, we have to go back to our skew curve. And I've talked about this in previous videos, but this is a particular layout of a skew curve that is called an out-of-the-money layout. And I've got the at-the-money strike here in the center in red, and therefore everything above that will be the calls, because higher strikes would be out-of-the-money calls. The lower strikes, everything below 50, would be the puts. So alternatively, I could lay this out according to all calls. I could make them all puts. But again, this particular layout is called an out-of-the-money layout. And that's what I'm going to do to show the differences between these call and put implied volatilities. So if the underlying stock is trading for, let's say, 20% volatility, this would be the actual historical volatility. Theoretically, every one of these strikes should trade at the same volatility. Now keep in mind, this is for a given expiration. So maybe these are the May options, for example. So that makes sense because if we're talking about the same expiration, the same underlying, everything's the same, why should these strikes trade at different implied volatilities? That just wouldn't make any sense. But in the real world, they never do. So instead of this being our baseline, in the real world, we might see that the 35 put is priced up here. It's going to be priced a lot higher than 20%. What about the 40 put? Might be a little bit lower. 45 put will be lower yet. 50 will be very close to the historic volatility. Going out of the money, the call, 55 call, will be a little bit higher. We're going to start moving up, and then the 65. So the thing to see here is that we are fairly symmetrical. And this is what's called, it's a skew curve, but typically called a volatility smile for obvious reasons. But the main thing is that at least this theoretical one, is that we will see for equidistant strikes, they should trade at the same volatility. So notice that for the 50 is the at the money. If I go 1, 2, 3 strikes up, I'm going to get a certain volatility. And if I go 1, 2, 3 strikes down, I should get that same volatility. They should trade at the same levels. That's at least theoretically. But as we're going to find out, in the real world, they really never do. And there's two main reasons that we're not going to get this perfect smile, at least in most cases. So the first one is the downside risk. So we all know that traders are terribly risk averse. Nobody likes to take losses. So traders are willing to pay for a downside hedge. And they're saying, yeah, I'm willing to buy this put that's 10 or 15, 20 points out of the money. And I'm willing to take some loss, but I just want to have it there as a disaster insurance. So, okay, that makes sense, but the sellers aren't so eager to sell these out of the money puts for very little money, but accepting large risk. So what's happening? We have a lot of people who want to buy. We don't have so many who wish to sell. That means we have more buyers than sellers, and yes, that means higher prices. So I've talked about this before in previous videos. Price is the equalizer. We can always balance a market through prices. So it doesn't really matter that we have more buyers than sellers. We can still balance the market through higher prices. But if we have higher prices on these puts, it means we must have a higher implied volatility. So that's what explains the higher implied volatility for these out-of-the-money puts. But what about if we go to the upside? Well, if we start looking at these upper strikes, we're going to see that there is a tendency to have selling pressure up there. And the reason is that more traders wish to sell the out-of-the-money calls to generate income and or enhance their return on investment or their ROI. Now, another reason they might wish to sell calls is to finance these long out-of-the-money puts. So think about it. If the stock is 100 and you want to buy the 85 puts, you might say, you know what? I'm willing to sell the 105 calls or the 110 calls to generate some income to pay for these puts. But the point is that we end up with more selling pressure up here to the upside. So if we have not as many traders wishing to buy these out-of-the-money calls, but in addition to this, we don't have as many traders wishing to buy out-of-the-money calls. Now, don't get me wrong. Of course, we get a lot of people who wish to buy out-of-the-money calls for speculation. But on a net basis, in most of the cases, we're going to find there are far more sellers of the out-of-the-money calls than there are buyers. So what happens up here in this range? We have more sellers than buyers, and you guessed it, that means we have lower prices and therefore a lower implied volatility. So now keep these points in mind, and if we go back to our skew curve, this is why we usually get this. It's kind of angled a little bit. It's not as symmetrical. So notice that our 35 is up here, 40, just like we were with the smile, but on the way back up, we don't quite get as high. See, theoretically, if we saw the 35 trading at this vol, we would expect the 65 to be there too. Or I could also say if the 65 is here, we would expect the 35 to be here as well, but they're not. The downside is shifted much higher up relative to the right. We've got more selling pressure over here. And that's what's causing this kind of a cockeyed smile, which is why they call it a smirk. So if you think about it, if these puts, let's say if these 35 strikes are trading at much higher volatilities, they're out of the money, so that means that their deltas are higher. That's the Trumpification effect that I've talked about in previous videos. So in order to get these deltas the same, in order to match maybe this delta, we've got to look further left. We've got to look to the 30s and the 25s and the 20s, and eventually they will match. But it's because of this higher buying pressure out here to the left that they're not going to match for an equally distant out-of-the-money option. So that's the volatility smirk. Again, it is very common in the equity markets. Now, as a side note, for any of you who might be trading commodities, we get the similar idea, but to the opposite side. You're going to see something like this. And why is that? Why do we get the bigger implied volatilities out here to the upside? Well, when you're buying shares of stock, you're buying cash flows. And yes, the downside is where the risk is. But in the commodities markets, these are the inputs to the things that we're trying to create. And so, all things being equal, we'd rather see lower prices. And so the risk is to the upside, right? So, assuming you're not the farmer, all things being equal, we would rather see lower corn prices and lower wheat prices and lower gold prices because those are the inputs. But we're not seeing that in the commodities markets because this is the risky side. So just keep that in mind. A lot of times you will see this kind of reversed, but it's the same idea, and that is the volatility smirk. And so hopefully that explains why you have to go so far out of the money for these puts to get the same delta for an equally distant out of the money call. Now that's all good information, but the real important point is how do you use this? And how do you set up your strategies so that you're not stepping into a trap? And so, for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.